In this video, I'm going to show you exactly how you can build a dividend income portfolio using ETFs on M1 Finance while also keeping risk and expenses relatively low. So let's go ahead and get into the video. All right, so here's how to actually build a dividend portfolio using ETFs, step-by-step guide. All right, so this is what we're going to be covering today, guys. Dividend ETFs and their benefits. We're going to be talking about the dividend ETF spreadsheet that I built out for you guys. And again, it's all completely free. I'll put a download link down below in the description for you guys. And we're going to talk about step-by-step how to build a portfolio. So you're going to see me log into M1 Finance and I'm going to be building it and kind of talking about it out loud. All right, so you guys can kind of hear my thought process for this. But again, there's no one size fits all, right? It all depends on the investor, the individual goals, individual risk tolerance, and all that kind of stuff. All right, but I will just be building it out and talking kind of my way through it, and hopefully it'll make sense for you as well. And then at the very end, I'm going to give you guys some very important next steps. All right, so let's get into it. Here's a quick disclaimer. I am not a financial advisor, financial planner, financial professional. Those are probably people you should talk to. I'm just some dude on YouTube who's sharing my experience. All right, so dividend ETFs and their benefits. So ETFs have a lot of benefits, right? Especially dividend ETFs. So you get diversification. Whenever you buy an ETF, you get immediate diversification, and that is really good. That is what you want, right? When you have this diversification, when you purchase a single ETF, it could be diversified into 50, 100, 200, 300 different companies. So even if one of those companies flops, it's not going to take down the whole portfolio, right? Like I mentioned in an earlier video, when you buy a single ETF, you don't have to pick or try to pick the winners, and you certainly don't have to worry about the losers. So when you buy an ETF, you're immediately diversified. So if you put $100 in, it's immediately going to go towards, the 50, 100, 200 different companies, right? So you're spreading your risk around, which is absolutely fantastic. You also get lower risk when you purchase into a ETF. And what do I mean by lower risk? Well, just like the diversification piece, when you invest into the ETF, you're also not going to experience that volatility or as much volatility as you would if you invested into individual holdings or individual companies, right? Let's say you have 5 companies that you invested into. Let's say 2 are doing really well, but the other 3 are going terrible, right? They're just going down. They're dragging the entire performance of your portfolio down, and now more of your capital is actually at risk. So this is why ETFs are so powerful. You also get regular income from these dividend ETFs. All right, so you're going to get this regular income on a quarterly or a monthly basis, without fail. The ETFs, they don't really have histories of dividend cuts. Mostly they've just been doing dividend raises, right? But not all ETFs are equal or created equal. All right, but you're going to have a basket of stocks or a basket of companies that are, typically what the ETF is going to want to do, or the fund manager of that ETF, they're going to choose companies with rising dividends or track records of dividend increases, right? Of companies that never cut their dividends. So there's a safety net there. There's, risk. There's lower risk when you invest in these ETFs. So that's that. Let's get into the dividend ETF spreadsheet that I built out for you guys. All right, so I got to go here to Google. All right, so this is it. And again, I'll have a link for you guys down below in the description so you can access this yourself. But basically, I listed out just a couple ETFs that I know of that are pretty good, and that they're not like high risk. Like there's QYLD out there, and a lot of people were jumping into QYLD, XYLD, RYLD because these things were giving you like 10, 15% dividend, right? Monthly dividends. However, the downside to that was your capital was basically eroding in front of your eyes. So if you put $10,000 in, yeah, you were getting, probably like $100 every single month, but your $10,000 was going down in value, right? The capital was going down. It wasn't, the fund itself was not appreciating. So I invested in the QYLD. I consider it a yield trap. I since, sold it and got out of it. But so I have that experience. So I would not recommend QYLD to almost any investor. There's tons of videos out there. There's a lot of articles out there. I would not recommend QYLD. So this is the dividend spreadsheet. I'm just going to go over kind of how it looks like, all right, or how you can use it. And I know my screen is like somewhere down in the corner, so I'll try to do my best to, walk you through the whole thing. Let's put this up. Yeah, there we go. All right, so we have the ETF name, and I'm a big fan of Vanguard. All right, so for those of you watching, try to always go with Vanguard stuff. All right, it's just a recommendation. You don't have to. So you have the ETF name. You have the description of that ETF, right? What the goal of that ETF. Every mutual fund and ETF has a goal, or they tell you exactly what they're doing, right? They tell you what the objective of that fund is. You have the ticker, right? So if you're on M1 Finance, Robinhood, Webull, whatever, you can look up this ticker and actually buy it. These are all available across all of those platforms. So even if you're not on M1 Finance, not a big deal. The expense ratio. So expense ratio is a big deal, all right, especially for long-term investors. You'll have, some investors that just don't care about expense ratio. They're looking at the dividend income, which is, in my opinion, not a good way to look at things. Expense ratio, especially if you're going to hold it for a long term, is very important because it could be the difference between paying, $10,000 in fees over the lifetime of the fund that you own it, or $100,000 in fees that you paid over the lifetime of that holding, right? So again, expense ratios are very important to keep an eye on, and it is something that you want to consider when you're building out a portfolio, right? If you're going to be building out a portfolio, look for low-cost ETFs, low expense ratio ETFs. All right, I also included the yield because I know that's what we're here for, right? Yield is, or they call it the dividend yield. It is the amount of money that you are expected to be paid back on an annualized basis. So if, let's take this as an example, right? The iShares Select Dividend ETF, they have a dividend yield currently of 3.25%, but they pay me quarterly, right? So that means you would divide that $3.25 over, 4 quarters, and that would be your quarterly payout, right? But let's take it a step further because I know that doesn't sound sexy, that doesn't sound exciting, but let's say it was $10,000, right? That's $325 a year. I know that may not sound sexy enough, right? But again, we're long-term investors. If you continuously buy into these ETFs and you do like a dividend reinvestment plan where you reinvest the dividends, then that can snowball into something much bigger, right? Let's say it's 100,000 that you have in here. On top of appreciation of the shares of the ETF, that could also be $3,250 a year that you're making passively in income, all right? Passive income. All right, so I know these yields, they may not look sexy, but you have to think long-term. You have to think bigger picture, all right? You're an investor. All right, so that's what we have for yield. I also included the number of companies, right? The number of companies is important because that is what's going to add to your diversification strategy, all right? When you're purchasing an ETF, you want to know how much companies or how many companies are in that ETF, right? If there's only 5 and one of those belly up or goes down, then that's going to drag the whole ETF down, right? But if you have 100, maybe 1 or 2 go bad, that's not going to kill the whole ETF, right? So again, it's part of that diversification and that risk strategy, all right, that I was talking about earlier. I'm not going to say that the more companies, the better, but I will say that definitely having a lot of companies is pretty good, right? Because some of these, like the Vanguard Technology Growth Fund, I think the ticker is VGT. That I think only has like 25 companies in it, whereas the Nasdaq, 100 composite, 100 companies, you'll have something like QQQ, and that has 100 or 102 companies in the index. So, but they're both technology focused. But if I'm not mistaken, I believe VGT actually has outperformed QQQ. So again, do you want to go with heavier concentration, or do you want to go with more of a risk, a less risk, diversified portfolio? Again, one shoe does not fit all right? So you have to take these into consideration. And then I put payouts, these are all going to pay you out quarterly, which means every 4 months. No, every 3 months, I'm sorry. Every 3 months they're going to pay you out quarterly, all right? Because there's 4 quarters in a year. But there is one I put in here. This one's a very popular one. I don't invest in it personally, but it's the Amplify Enhanced Dividend Income ETF, and they offer a 5% yield. They only hold 25 holdings. The ticker is DIVO. Now, there is a lot of income investors, dividend income investors that have invested into this. It's done relatively well, but I just have not, because I don't like investing too much of my income into ETFs. I prefer having individual stocks, but I have invested into ETFs before, right? And they are powerful. They are good for some investors, all right? Again, it all depends on the investor. All right, so you can also check them out. This is their websites for each of them. And you can go in there and kind of just see more information about them, read the perspective, read the objective, see some historical trends, their dividend records, things like that. So again, this spreadsheet will be available to you for free. Feel free to look at it, go through it, and absorb it. All right, so that is the spreadsheet, and this is what I'm going to use to build out our M1 finance portfolio. And I'm going to walk you through here in a second kind of my thought process for building out this portfolio. All right, so I'm going to go ahead and log into M1 Finance here. And then we're going to discuss steps to build and manage your portfolio on M1 Finance. All right, guys, so I just logged into my M1 Finance portfolio. We're going to go down into research, because this is where we're going to build it. All right. So we're going to go to research, and we're going to want to do, we can do funds, right? We're going to create a brand new pie. All right. So let's go here. Actually, let's start with pies. All right. So we're going to build a stock and fund pie, and we're going to call this the, let's call it portfolio, right? My portfolio. Now, this is me as a brand new investor. I'm building out this portfolio from scratch. Okay, this is as if I haven't invested a single dollar, or maybe I want to start investing in this, right? Let's say, like currently I'm invested in a lot of REITs, as some of you guys know. Let's say I wanted to add this portfolio to my current portfolio. This is how I would do it. All right, so I have my portfolio, and we're going to add a slice. Now, as an investor, and I want to remain as passive as possible, and I don't want to be involved in reading quarterly reports or listening to the news, or following trends and things like that. Like, I don't want to be reading and spending my time reading through reports from Microsoft or Apple or Nvidia. Instead of, the quote is, instead of being a player in the casino, just own the casino. So I'm going to go with an index, right? I want to build out my index. So I'm going to go to funds, and one of my favorite ETFs out there is the Vanguard S&P 500 ETF. So I'm going to start with this one, right? And we see that it has a dividend yield of 1.31%, nothing too sexy, right? An expense ratio of about 0.03%. So I'm going to start with VU, and I know that I also want some high growth in this portfolio, right? So I'm going to include just a little bit of QQQ, or you know what? Let's keep it with Vanguard. So let's look for VGT. Boom. All right. So let's go with VGT, right? And now, using this spreadsheet here, I want to go with probably SCHD. I'm going to go with SCHD. Now, SCHD, who is Charles Schwab's, dividend income ETF, it is the king of dividend income ETFs. It has the longest track record compared with most of these other ones, and it's touted as like one of the best funds you can own, so you can sleep well at night, right? A lot of investors have also been touting DIVO, but again, my goal is to keep expenses relatively low. So I'm going to go with a relatively low expense fund. Even though I'm not going to be paid monthly like DIVO would pay me, I'm going to go with SCHD, which will pay me quarterly. And I'm pretty comfortable with that. So let's go back and let's look for SCHD, SCHD. We're going to type it in the top. Boom, there's SCHD. All right, we're going to add this to the basket. Now, this is where we can stop, right? We have some decent diversification. You know, we have technology, high growth, a little higher risk. We have the S&P 500, which is a basket of, 500 of the best, largest market cap weighted companies in the United States. And then we also have a dividend income ETF. All right, so we're going to do that. We're going to hit add. And now we're going to work on our allocation strategy. All right, so I hope you guys can see this. I know my screen is going to be somewhere down in the corner, so I hope you guys can see this. But basically, let's say I want to focus more on income than I do on anything, right? So I want to have my target probably a little higher, maybe like 50%, right? Actually, let's say 60%. I want to have it at 60%. Right? But I also want to be able to capture a lot of growth in technology, because these dividend ETFs, they don't grow or appreciate fast like, like tech stocks, right? Like something that's in the QQQ or VGT, right? So I want to capture that growth. I absolutely want to capture that growth. I want to keep my portfolio diversified. So I'm going to give this probably, let's say 25, right? 25. So that means I have, about 15% left. All right, so with Vanguard, I'm going to go with the remainder, 15%. Boom, right? And then I can save this pie. And this is, my portfolio now. So if I go down, these are unused, stocks and stocks and fund pies not used. So I can go to my portfolio, and then I can add it to the portfolio, right? Add it to the actual brokerage account. And then when I do that, I'm not going to do that here because I have a live, portfolio, and it would kind of screw everything up, but I'll try to take it as far as I can. So I would add this to portfolio, choose my income portfolio. I would hit add. And of course, I have my equity REITs, I have my BDCs, but I have this right here. Maybe this could also be just the dividend ETFs, right? Like I had listed earlier. Maybe I could just have income ETFs, right? And completely change this, and just have different income ETFs. But, let's say I don't have the equities, or the equity REITs, I don't have the BDCs, and it's just my portfolio. This is what I can do, right? Boom. You can add it, and then you're basically going to go purchase it, right? I can't change it right here, because if I do, it's gonna trigger some events, and then I'll have to go back and change a lot of it. But let's see what happens. Boom, we'll add that, we'll hit save, and let's see what happens. All right. Yep, I want to confirm this. Okay, so now I'm in my portfolio, and we're gonna go to my portfolio. Let's say I have some money, which I actually do. I have $4,000 sitting, waiting to be deployed, and I want to purchase this portfolio, right? I want to purchase in these allocations, only this, right? So what I can do is go down here, and I can auto invest, but it'll include everything, my entire portfolio. So I just want to buy what's in here. So what I will do is hit buy up here underneath these pies, click buy, and we're going to do 100 bucks, right? So we're going to do $100, and we're going to confirm buy. And then boom, we're going to check what 3 buys we have. And we have 60, 25, and 15, right? So it's automatically going to change, it's going to divvy up the money based on the allocations that you set. All right, so let's go back, and I want to change this all up, because I want to give you guys, kind of a difference in portfolio construction. So we're going to cancel this, cancel that order. All right, let's go back to research. Let's go to research. Let's go to our pies. And let's say you're adding to your M1 Finance portfolio, right? Let's say you're adding to it, and you want just income ETFs, right? Income dividend ETFs. All right, let's look at, where did I put portfolio? Oh, I added it, that's why. All right, let's go to my portfolio. We're gonna change it up a bit. We're gonna edit this. See, I mean, it looked like it's done pretty well. I mean, since 2016, and it's producing a dividend yield of 2.553%, which, isn't bad. And expense ratio is pretty low. So that means you're going to be paying, I think, like $7 on every $1,000. So again, pretty good there. But let's say I want to increase that dividend, right? It's not enough. I want more dividend income, right? I want to build a portfolio focused on dividend income. So we're going to change this. Let's kick out VGT. Let's kick out VU. I don't want that as part of my new strategy that I'm building out. Let's see if I can minimize this. All right. Let's see if I can delete this. Okay, cool. So we're going to add slices, and we're going to rename this portfolio in a second. So going back to the spreadsheet, we have Devo, 25 companies. Ooh, this one's a pretty high dividend yield, 75%. Expense ratio is pretty low. I mean, that's pretty decent. It's only 2 more points than SCHD. So let's add this one. Let's add HDV. All right, let's see what HDV looks like. HDV. All right, so HDV over 5 years. No data available. Oh, there it goes. All right, so I mean, it looks like it's been relatively stable. It's kind of in a flat line. Doesn't look like it's growing like crazy. And it's a dividend payment of 3.53%, so that's pretty good. Expense ratio of 8. Has a market cap of 10 billion. Market cap of 10 billion. Excuse me. So, I mean, it looks pretty decent to me, and these are the holdings in there. So you got ExxonMobil, you have J&J, AbbVie, Coca-Cola, Ultra Group, Chevron, Verizon, etc. So not too bad. You know what? All right, I like this. Seems pretty stable. And I wonder if the fund, if it tells you how long the fund's been around. So I don't think so. Yeah, not in this, but like on Seeking Alpha, it'll tell you when the fund's been established. So you can keep it, you can kind of see how long it's been in use, or how long it's been in operation, I guess. You can also see the assets under management, which is a huge deal. AUM, absolutely want to know how much AUM it has, because AUM, assets under management, means that is how many investors are buying or putting money into the fund, into the ETF, right? Something under 100 million, might be okay. Sometimes I like to look at ETFs that are in the billions, because I know that's a little more safer. More investors are putting their money into it. And if I wanted to pull my money out, there won't be a liquidity issue or anything like that. So HDV, I like it. Let's add it to the basket. All right, going back to our fund here. Okay, our spreadsheet rather. You know what? I'm a young investor. I want to, I don't mind paying expense ratios, higher expense ratios, as long as I get higher return. That is me as the investor. That makes sense for me. I'm going to go with Devo. I like Devo. Devo offers a monthly 5% yield. So let's go with Devo. Let's take a look at it. All right, cool. So this is Devo. As we can see over the last, let's see if the data is available for 5 years. Yep, since July 19, or since early August 2019. These are kind of the performance of it. So it actually looks like it's been growing. And of course, you want to make sure you're reinvesting those dividends. And it's, a dividend yield of 4.5%, so a little less than what I had on the spreadsheet. An expense ratio of 5.6%. All right, so that's a pretty decent expense ratio. I would never recommend. I have invested in ETFs that were at 0.5%, 0.50%, but I would never invest in anything probably higher than that. I know that there's some really crazy funds out there. Like I think there is the Bitcoin ETF that's out there, and I wanted exposure to Bitcoin. But that expense ratio was like something like, I think like 1 or 2%. I think it was something crazy. And there's ETFs out there with 10% expense ratios. Actually, I think that's what it was for the Bitcoin ETF. It was probably 10%. But yeah, there's a BDC ETF out there that's expense ratio, I think, is like, almost 10%. The higher the expense ratio, the dividend yield was about 10% for that ETF. It's mouthwatering. But when you're going to be paying, your whole dividend in expense, what's the point? So again, these are things you just have to kind of think about. This is what I'm just talking out loud here. So this is Devo. Let's see what some of the companies it has. Microsoft, okay. United Health Group, JP Morgan, PG, Cat, Home Depot, Goldman Sachs, Apple, and Visa. So this is constructed a little more differently than the last one, than the iShares one. So that's a good thing. That means we have probably less crossover than we care about, than we care for. And when I mean crossover, I mean like if you had like 3 ETFs or 4 ETFs that were all dividend ETFs and they all had the same exact companies, then the diversification is not there, right? Because it's all the same companies. But the top holdings for Devo and the top holdings for the iShares ETF are different. So that's pretty good, not too bad there. So I like it. Let's see. Yeah, so I like it. So I'm going to add this, right? Boom. All right, so we got this. All right. So I want to do this split across the board. I want everything equal, right? So we're going to do 33% to SCHD. We're going to do 33% to the iShares Core High Dividend ETF, and then 34% to Devo, right? I want everything equal. When I put in $100, I want $33 to go to SCHD. I want $33 to go to the iShares Core High Dividend ETF, and I want $34 to go to the Amplify Enhanced Dividend Income ETF. All right, so we are good here. Let's go ahead and save this. Yep. So I just noticed, I hope my screen is not blocking all of that, but I'll show you here in a second. All right, so this is what this looks like now. And now I have a dividend yield of almost 4%, right? 3.9%, an expense ratio of 0.24% with only 3 holdings. This is my portfolio. And I mean, if we look at it, the past performance, it looks like it's been going up, right? It looks pretty good to me. So we're going to go back to actually, I'm going to edit this and I want to give this a name, right? I want to call this my income, or I want to call this income ETFs, right? We'll call it that. Boom. So now we're going to go back to my portfolio and we're going to buy this thing. So let's go here, invest, income portfolio. All right. So we're going to go to income ETFs, right, that we just made. And we're going to buy. And we're going to buy for $100. And then boom. So we confirm we have 3 buys coming. And we have $34, 33, and 33, just like I said, right? Boom. All right. And it's going to happen today, 4:30 p.m. on Monday. Well, it'll happen on Monday. Today I'm filming on Saturday. So that is how I would build or construct a dividend income ETF portfolio, right? Using ETFs that are available to you on almost all brokerages and all platforms. But this is kind of my thought process, right? This is how I would look at things. I'm looking for income, and I want to invest money, and this is how I would look at it. You could go with just Devo. You can go with just HDV or just SCHD by themselves. You don't have to mix and match them. You could just go with one, right? You don't have to choose all 3 or 5 or 6 or 10. You could just go with one and be still relatively safe with risk and low expense ratios, all right? So with that being said, let's move on. All right, so we just went over steps to build and manage your portfolio on M1 Finance. Here's some kind of takeaways to manage your portfolio, right? You want to follow your allocation strategy. Whatever your allocation strategy is, it can change over time, and that's okay. But you don't want to be changing it every single day, every single week, every single couple of days, right? You want to stick to the strategy, right? This is why I like M1 Finance, because it kind of forces you to stick to it. Like, you're not always thinking about it, right? It's just done for you. It's already done for you. Just put your money in and you let it divvy it up, and you buy the ETFs that you like, right? But you want to follow your allocation strategy. You want to monitor this portfolio, not like a hawk, but maybe check in with it maybe once a month, maybe once a quarter, right? You just want to check in with it, see how it's doing. Does it still meet your standards? Does it still meet your goals, your criteria? Did any special circumstances change for you? Maybe I don't know, maybe you're all about income, right? Creating passive income. And now you're like, you know what? I want to include growth. Maybe I want to include QQQ or VGT or the S&P 500 index. Maybe I want to include something else. Maybe I want to include a little more of a risk. Maybe I want to follow a core satellite approach, or core satellite strategy, which is, maybe one ETF is a bulk, and then you have a couple different little stocks here and there, right? But again, it all depends on you as the investor. You want to reinvest your dividends, all right? Reinvestment of your dividends is so crucial, especially in the early days, especially when you're getting started, right? Because what you're doing is you're creating a snowball effect. When you reinvest your dividends, you're buying shares of whatever company or whatever ETF that's producing them, right? So you're buying more. If the ETF goes down and you get dividends, it's going to buy shares at a lower price, right? And it's automated. When you use money to buy money, and that money produces more money, and then you use that money to buy more shares, which gives you more money, you see how this works? It's just a nice cycle, and you start building your cash machine. So you always want to reinvest your dividends. Maybe you get to a point where your dividend income is really high and you want to start using that money for other things. Maybe you want to use it to invest in other assets. Maybe you want it to cover some of your expenses, right? But that's the beauty of dividend reinvestments, is that you're going to be growing that snowball to a point where the dividend income could either supplement your income, or maybe you move to a very low cost area, low cost country, and maybe your dividend income actually replaces your income, right? That is what I'm trying to build. That is what I'm striving for, is having my dividend income or investment income replace my active income, right? You also want to think about rebalancing. So rebalancing really, really quick at a high level, you're going to have ETFs that go down in value, ETFs that go up in value. You're going to have companies that go down in value, up in value, etc., right? What a rebalance is let's pretend you had the three from earlier, right? You had VGT, S&P 500 index, and SCHD. Let's pretend for a second that VGT went down in value, right? Substantially. Let's say it lost, 10, 15% of its value. And for the year, right? It's just down. S&P 500 index is probably down like 8 to 10%, right? But your SCHD has been doing really well. It's been going up in value. It's been paying its dividends, every quarter. And then at the end of the year, its shares are doing much better. It's appreciated in value, maybe like 10 or 15%. This is where you want to rebalance. And the beauty of M1 Finance is that you can rebalance automatically. And this is why I love, M1 Finance, because back in the day, you would have to, kind of chart everything out, write everything down, and then decide, okay, I'm going to sell 20 shares of this, sell 15 shares of that. And then you would have to go put those orders in through the brokerage, right? It's very labor intensive. With M1 Finance, all it is just a simple button, right? You click rebalance. But you got to be careful with this. You got to absolutely be careful with that, because when you hit rebalance, it creates what's known as a capital tax event. So you want to only do this maybe once a year, maybe once every 2 years, maybe once every 3 years. It all depends on you, right? I haven't rebalanced in about 2 or 3 years now because of the bear market we are in with real estate investment trusts. So I haven't really rebalanced in a long time, but I will rebalance in the future for sure. But rebalancing allows you to purchase, shares that have become, out of favor, that have went down in value, with shares of companies or ETFs that have appreciated in value, right? So you're going to be rebalancing it, and it's going to go back to its original allocation strategy. All right. So, but again, you want to be careful with the rebalance button. Don't just do it every single day. Do it only once a year, maybe once every 2 years, all up to you, right? It does create a capital event. And what it does is, like I said, it just buys shares, well, it sells. Say you have like SCHD that is now performing, at 50%. It went up in value, it's doing really well, but the other two are not doing so well. What it'll do is it'll sell some shares from SCHD and buy the other two automatically. It does it all automatically for you, and it resets everything back to your allocation strategy. So I know that was a lot to take in. I hope I didn't confuse you, but all right. So that's that. If you guys like this type of, YouTube channel, you guys like this type of content, I'm building a free community. All right. I'll put the link down below in the description, but it's going to be a community of other investors, new seasoned investors. I created a investing masterclass. It's available through the platform. I'm going to be implementing coaching calls, doing coaching calls as we grow our member count higher. And yeah, I hope you guys join me, and I'll see you guys in the next video.